Michael, if we can start with Australian inflation, I mean, just how good a job do you think the RBA is doing getting CPI under control?
Terrible. So does the market. CPI is still going to be between 6 or 7%, and it doesn't seem like it's going to come down quickly. The RBA itself is one of the slowest in terms of when it thinks it will bring it down. So I think it's going to be sticky for a good long while yet.
We saw the RBA pause on rate at its last meeting, though. I mean, do you think then that was too early, and what risks does it pose in doing this?
Well, I think it is on balance too early. Inflation will be sticky. Obviously, they were doing that because of the housing market, even though they won't say so. But I think that's the wrong call for them to make. And it does risk that they end up having to do even more further down the line. And that's the problem with holding back. You then have to give more later on.
So do you think the numbers that we might see tomorrow in the quarterly CPI account might give the RBA gumption to move again on the upside?
It depends where they come in, and you could have a surprise on either side. It wouldn't completely shock me if you got slightly softer numbers in Q1, which would be a big relief for them. But it doesn't mean at all you're going to get softer numbers in Q2 or Q3 or Q4. And that's where the problem lies. It's not a short-term thing. It's a structural, longer-term problem.
Okay, if we look more broadly around what central banks are doing globally, I mean, how would you characterise what they're doing in tackling inflation and their approaches towards that?
Well, up until now, mostly hiking and hiking and hiking, thinking about pausing and then realising they've paused too soon in most other places. And I think the RBA will be the same. But we had a really, really important speech from the ECB President Lagarde last week, which echoed something in my own research, rather arrogantly, if I say I'd been flagging as inevitable for years, which is that the central banks would say, look, we have to keep raising interest rates. We're going to do that. But we have to step in to help the government where they're spending money on the supply side. That means infrastructure. That means bringing back jobs and supply chains. And on national defense, that means paying for the military. If we don't do all of those things, she said, we're not going to have low inflation because it's not all within our laps. It's a global problem.
Is there a problem, though, Michael, that these central banks will overshoot with interest rate hikes and therefore cripple growth and ground the economy to a halt?
Sure, that really is a risk. And I think a lot of people in the markets are trading it that way. But here's why that links back to what I just said about what Lagarde was saying. What she's indicating is, look, we can keep hiking rates. And you know what? That's going to blow up parts of the economy. It is. There's no way to avoid that. But while rates are high for some parts of the economy, we are going to support, basically printing money, other parts of the economy to make sure that they do okay. So say, for example, the housing market might really be rocked, but we might build up a big defense supply chain network in Australia, again, employing hundreds of thousands of people, building ships and, rockets, etc., etc. Now, would you rather have housing or rockets? I'm not making that choice. But I am saying central banks might do both at the same time.
Are you one that falls in the camp that sees a risk of stagflation, which we know is high inflation coupled with economic stagnation? Is there a risk of that? What is the recent data telling you?
Absolutely. Stagflation is additionally a risk. There are risks wherever you look. There are risks of not doing enough and then we get high inflation. There are risks of doing too much and then we crash and we have a recession and deflation. And we have a risk of stagflation where we have growth bumping along the bottom and inflation just won't go down. And that's one of the reasons, again, why I think central banks need to think in a different way and admit we need much more liquidity in some areas where we're really short of stuff. And we need much less liquidity in other areas where all we've got is bubbles and too much stuff.
So what do you then see as the most likely scenario to play out around the growth story or the lack of growth story?
Well, probabilistically, you have to say that the least likely scenario is the happy one that the RBA has been telling us, which is growth's pretty good, inflation comes down slowly, and we're all off to the races again in a couple of years. That's very unlikely. All the other nasty scenarios where you crash and have very, very low inflation, or they don't do enough and we have persistently high inflation and or stagflation, these are much, much more likely. And maybe it's a coin toss between the two. It depends how you look at it. But the happy scenario, I'm not putting much money on that.
There's also a huge amount going on geopolitically, the war in Ukraine, relations between China and the West, possible G7 sanctions on all exports to Russia. They're all in the mix. I mean, what is that doing to the outlook? Where is it directing capital? Is that why we're seeing the boost in gold and maybe short-term bonds?
Yes, some of it's definitely going into gold, although ironically, that's not from the Western side. That's from the other bloc, if you will. They're looking to try and avoid the dollar where they can, to a degree. Certainly, you can see that the people who understand these problems are thinking much more defensively. And let me just take a few seconds to say there are very, very serious people from very serious institutions and serious media like the Financial Times, Foreign Affairs, etc., who are openly saying, look, we can see more wars in Ukraine happening in the near future if we're not careful. The Australian government is using similar language, even if it's coding it a little bit. And in that environment, it does tend to be more risk off than risk on. But you do need that support from the central bank and the government telling you we're going to need money to go here to give you a bit of guidance. And I think we'll get much more of that going forward.
Michael, what trend do you foresee in this time of political uncertainty and financial instability?
Well, it's going to be, to use the word deglobalisation, but people disagree on what that means. It certainly means the shortening of supply chains. It means trying to be more resilient where you can be. And that means having multiple export options and multiple import options and spare capacity. Nobody wants to be running just-in-time facilities anymore. Everybody wants to be just in case. And in the worst case scenario, it ends up being just for me so that you have stuff and other people don't.
Michael, always great to speak with you. Thank you very much for joining us.
Thank you.